Firstly, on behalf of Grant Thornton, you're all very welcome to our webinar this morning. We ran a general webinar on funding supports on Monday. We opened it up last week. It was full in 15 minutes. And there was a lot of interest from the Retail Ireland members, Retail Excellence Ireland members. So we decided to run one and tailor it specifically to supports available to retail businesses. Obviously, there are plenty of Enterprise Ireland and other supports out there as well, but we said we would tailor one, and hence this is what we have this morning. So it's focused on retailers and REI members in particular. And I think there's something here for small companies, for larger companies, and everyone in between. So we'll run through the various supports and we'll take you through this presentation. I guess just before we do, just to maybe put it into context and set the scene, we've been busy for the last 3 or 4 weeks speaking to our clients, to intermediaries, and to banks. We think that some of the current supports that are there have been very helpful. The wage subsidy, the moratorium on bank payments, the PAY and VAT deferral, and so on. So some of those have been helpful, but that was phase one of COVID-19, which was effectively the lockdown and the hiatus. We're now moving into the next phase, which is coming up shortly, and I'm sure you're all focused on that as retailers, which is what many people are calling the reboot, but in retail terms is really the reopening for many of you. And we do think that the emphasis is going to switch. It's going to switch to the funding of working capital. It's going to switch to dealing with the deferred payment overhang. So whatever payments have been deferred or backed up, they'll have to be, negotiated, addressed, termed out, or whatever. For retailers, the reconfiguration of the store layout, potentially operating at a loss for a period of time until the physical distancing and measures are fully relaxed, which could be much later in the year, and obviously then the legacy balance sheet and any matters that come out of that. One of the things we're going to cover, the presentation is in effectively 3 parts today. So I'm going to firstly cover the supports available from Microfinance Ireland, Leo, Enterprise Ireland, and SBCI as they apply to retailers. But we're also going to focus very much on the cash flow, preparing cash flows, how to keep them up to date, because we think the critical thing in all of this is being on top of your cash flows, having a good cash flow model, and constantly sensitizing it to look at where and to be prepared to where your cash flows might end up. We think it's very important to engage with stakeholders early, to plan early, and to do scenario planning so that you've covered off various scenarios and what that would mean for your business. We do believe that most businesses will need some form of funding at some point to get them through the rest of the year. And while there have been good supports to date, we know that there are plenty of ongoing discussions about additional funding measures being made available. And I've no doubt that we will be updating this webinar and potentially having more webinars as the year goes on to do all of that. In terms of, I guess, just to introduce today, so I'm a partner in our Dublin office, and I cover a lot of the Leinster region. So I'll be doing the first half of the presentation. Dara Kelly, who's a partner in our Limerick office and covers Munster, will be covering the cash flows and cash flow planning. And then for our Q&A, we'll be joined by David Farrell from our Longford office, who covers the Midwest and the West. So we'll hopefully give you good regional coverage in terms of all of that. We'll take the Q&A piece will be at the end, and so we'll hold questions to then. There's a Q&A button at the bottom of your screens. So anyone who wants to put up any questions, if you feel free to put them up during the seminar, and at the end we'll come back to the end of it and go from there. Okay, so just moving in, I guess, to my part of the presentation. So I'm going to run through maybe 6 different schemes that are available at the moment. There's the Enterprise Ireland online retail scheme, and then there's 3 SBCI measures. There's a working capital loan, the future growth finance loan, and the credit guarantee scheme, all of which we're seeing some activity on at the moment. Then Microfinance Ireland, the COVID-19 business loan, and then some of the local enterprise office supports. So moving firstly onto the Enterprise Ireland online retail scheme. So in summary, the features of this are, it was set up to develop Irish retailers their online capability to sustain them through the current crisis, and really to encourage retailers to develop more competitive online offerings, enabling them to increase their customer base and and beef up their resilience during this crisis. The initial fund size is 2 million. There is discussions that that will be extended, and that more money will be put into this. Formally, there is nothing formal in relation to that yet, but certainly at the moment, there's an initial fund size of 2 million there, and it's a competitive process. So I think that's very important. This isn't just a question of ticking the boxes, filling in an application form, and waiting to see what happens. This needs a little bit of thought, and you will be up against other retailers, and so the more effort I think that's put into this, it's likely to yield the better outcome. There's an 80% grant up to a maximum 50k spend. So 50k is the maximum spend. You can certainly spend more than that, but only 50k will be eligible, and 80% of that would be a maximum 40,000 grant. It includes some internal costs of the company. So that includes the project champion. So if you have somebody internally on the online side, on the marketing side, who's going to project the champion, at certain rates you can claim so much per day at agreed rates for how many days they spend on the project. The fees of service providers then to develop digital strategy and enhance the online presence and the back-end systems. Enterprise Ireland on their website have very specific detail as to what expenditure is allowable and not allowable. So we'd recommend that you look at that. It applies to Irish-owned retailers, so that's important. So they have to be Irish-owned. So overseas subsidiaries of Irish subsidiaries of overseas groups rather wouldn't qualify for this. And you must have more than 10 full-time equivalent employees. So if you have 2 part-time employees at 50% each, that counts as 1. 10 full-time equivalent employees, and the effective date for that is at the end of February this year. You must have an existing online presence. So if you haven't been online already, now that is a little bit vague. It says website or social media. So most companies would at the very least have that, even though they mightn't be trading online. You must have a retail outlet, and I presume everyone on this call has a retail outlet, and derive the majority of revenue from your retail outlets. There should be some ambition shown to export in the future. And I think that's just because this is an Enterprise Ireland run program. That's not the most significant part of this, and I think that's an area that once you show some ambition, you do not necessarily have to be exporting today. So that's quite important. There's a minimum expenditure of 12,500. So if you're not prepared to spend 12,500 in boosting your online capability, which would be at 80% would be a 10,000 grant, well then you wouldn't be eligible for this scheme. And bear in mind that up to 50% of that expenditure can include salary costs for your champion. Very important that it excludes franchisees. So if you're a franchisee of a particular brand, unfortunately it doesn't apply. It obviously includes hotels, restaurants, pubs would be caught as well. So anybody whose main business is the sale of alcohol, so that would include off licenses, or the sale of particular tobacco products. That isn't to say that a retail business that is selling, that has a small off license, doesn't necessarily qualify. I think it's where the main business is in that area. Primary agricultural producers, and obviously gambling. Enterprise Ireland don't support the sin stocks, so things like gambling and so on don't apply. So as I say, very detailed guidance on the website for Enterprise Ireland, and we'd advise all eligible retailers to look at that in detail and to begin to prepare the information needed to avail of it. The submission deadline is Wednesday, the 20th of May. So it opened up this week. It's a 4-week process. It's important to have a well thought out plan. You do need to show, a need for funding. If you have $1 million in the bank and you're going in looking for this, they're going to, like, if you don't technically need the funding, and it's very clear you don't need it, then it's going to count against you. The impact of the project on your business, and from talking to Enterprise Ireland, That's very important. They want to see that this is impactful, that this makes a difference, that people are going to use this money and take it seriously to try and improve and enhance their online presence. Internal resources, very important that you have a project champion, that you have somebody internally who can drive this and be that person. And then, you know, from I guess ticking the box, you need to submit your latest set of statutory accounts. Now, it says very clearly statutory accounts. Some of you may be, it doesn't say audited accounts, so some of you may be pre-audit thresholds, and if you're below audit thresholds, then it's your most recent set of statutory accounts, which have to be not greater than 2 years old. So I would presume the majority or everyone on this call should certainly be able to do that. The evaluation then, they've been very transparent. They've given a sense of the scoring. So the quality of the proposal and the impact, which is very important, the impact this will have on the business, that's worth 40%. The impact of the proposed changes on the competitive position and the viability of the company is worth 40%. So the bulk of this is to do with the impact and on the plan itself. The ambition to internationalize the business, which is effectively export, is only attracts 10%. And the company's financial track record. So if you're worried about the track record or the balance sheet of the company, again, that only applies for 10%. So they don't have a weighting here that means that if your business is challenged, that you wouldn't get it. So that's the Enterprise Ireland online retail scheme. And again, we recommend that you go online. I know Retail Excellence have submitted some summaries from Enterprise Ireland of how that scheme works. There's a little bit more detail, but well worth looking at for retailers who are interested in that space. So I'm going to move on to the SBCI working capital loan next. So this is a loan that it ranges from a minimum of 25,000 up to 1.5 million for enterprises for a period, for a term of between 1 and 3 years. Any loans up to 500,000 will be unsecured, so security will not be required. There's a maximum interest rate of 4%, and there is a potential for optional interest-only repayments at the start of the loans for a certain period of time. The loan amount and the term is just dependent on the loan purpose itself. So the loan use cases are for future working capital requirements. So this one is for working capital. It's not for other things, which I'll come on to in a minute, but it's specifically for working capital. It's also to fund innovation, change, or adaptation of the business to migrate or to mitigate the impact of COVID-19. So with that in mind, I think for most retailers, the adaptation of the business to mitigate the impact of COVID-19 is what will effectively qualify them and tick the box. It's specifically not for refinancing of undertakings in financial difficulty. So if you're in extreme difficulty with your bank, with your existing bank already, and you're just looking to move to another bank, then this probably isn't. This is about new working capital facilities or the refinance of existing debt. So it's not about taking existing loans and replacing them. This is about new working capital facilities into the business. It's available to micro, SMEs, and small mid-cap enterprises. So fewer than 250 employees, turnover of 50 million or less, or the net assets are 43 million or less on the balance sheet. These businesses have to be independent and autonomous. So by that we mean not part of a wider group of enterprises. So they would be largely standalone businesses. Less than 25% of the capital in the business held by public bodies, and established and operating in the Republic of Ireland, and be viable. So if the business is not viable, well then, then there's going to be a challenge straight away. And just maybe before I move on to the next slide, and I'll just talk about the working capital loan and just how it operates in a little bit more detail. It's channeled through the pillar banks, so AIB, Bank of Ireland, and Ulster Bank. They will process the loan application. This was originally what some people would be familiar with as the Brexit loan scheme. So it was set up for a different crisis, and now they've adapted it and extended it to make it in terms of the COVID situation. How it works is that you go to SBCI, they approve your eligibility. So they have eligibility criteria. Retail businesses will qualify, and they have eligibility codes. So they approve them, and then they issue you with your eligibility. And when you have that, you then go back to your pillar bank and you go from there. We had Nick Ashmore from the SBCI on our webinar earlier in the week, and he said that they have a 48-hour turnaround for eligibility codes at present. They have issued 1,100 codes for 1,600 applications in the past 3 weeks. So that was as of Monday. So they have, they have been busy, and 1,100 codes have been issued. Their feedback is that the banks have followed through and lent money through the scheme. It was originally a 200 million scheme. There's another 50 million has been added, so it's been topped up by 50 million. And we understand that there's another 200 million in the pipeline that is not formally announced yet, but there are discussions going on in the background to extend the scheme by another 200 million. So if this meets your criteria, it's short term in nature, it's 1 to 3 years, it's working capital focused, then you should look very carefully at that. So that's the working capital loan scheme. So now I'm going to move on to the future growth loan scheme, which is, again, is another Strategic Banking Corporation of Ireland initiative. The loan features for this one is it's a longer term, so it's 100,000 up to 3 million, and it's over an 8 to 10 year period. And loans up to 500,000 are unsecured, so they don't require security. Under this, loans above 500,000 will require security. There's an initial interest rate of 4.5% for loans below 250, or 3.5% for loans above 250. So that's variable over the term, and that's reasonably competitive. Again, there are optional interest-only repayments in certain circumstances, or for the initial periods of these loans. The loan use cases for this, because it is about future growth, it's about investment in machinery, equipment, R&D, business expansion, premises improvement, process innovation, people or systems. Again, a bit like the other loan, loans to undertakings and difficulties. So, if the business clearly doesn't have the capacity for repayment, and if they're in real financial difficulty, you won't qualify. The finance of pure real estate development will not qualify, or pure financial transactions. And there's some additional restrictions as well, which are on the SBCI website. Again, this is available to micro SMEs and small mid-cap enterprises, so fewer than 250 employees, turnover of less than 50 million, 43 million balance sheet size, independent and autonomous, so again, not part of a group, less than 25% of capital held by public bodies or institutions, established and operating in the Republic of Ireland, and is a viable business. And again, just to maybe talk about this one again, this one is channeled through the pillar banks, obviously through SBCI, but then lent by the pillar banks themselves. KBC are also, so as well as Ulster, AIB and Bank of Ireland, KBC are involved in the future growth scheme, and KBC have capacity. Some of the other banks have used up most of their capacity. KBC still have capacity at present. Now, the one thing I would alert you to in relation to KBC, their business banking offering is almost exclusively focused on professionals and professionals' businesses. So that includes accountants, lawyers, doctors, dentists, architects, and so on. But it also does include, from a retail perspective, opticians and pharmacies. So I think certainly from an REI point of view, opticians and pharmacies should certainly look at addressing the capacity that KBC have to lend money in this space. And again, if anybody needs any introductions to the relevant people in KBC, we'd be happy to introduce them through Grant Thornton. So that's the future growth loan scheme. And next then, and finally under SBCI, we have the credit guarantee scheme. Now, the credit guarantee scheme has been around for quite a while. It provides an 80% guarantee to participating banks. Again, it's the three pillar banks, AIB, Bank of Ireland and Ulster Bank. And it mitigates the credit risk or the need for collateral. So what it does in this case is it provides an 80% guarantee. So it makes it a lot easier for the pillar banks to issue the loan on the basis that 80% of the loan is guaranteed through SBCI. It's available on facilities from 10,000 up to 1 million, terms of up to 7 years, and it's available on a number of different types of loans, from term loans, demand loans, performance bonds, and so on. Again, there's like the other schemes, there's optional interest-only repayments in the first 3 to 6 months. So the credit guarantee scheme is effectively a scheme that supports the general lending that the banks do. So it just deals with the security deficit or the whole issue of inadequate collateral that people might have when going for a loan. So it can be used by businesses to obtain loans to support changes they need to make to their business in response to COVID-19, but who might have barriers to funding, which could be inadequate collateral, a new business market sector technology, or perceived by finance providers as higher risk under current credit risk practices, or the need for refinancing caused by an exit of an SME's lender from the Irish market. Now, I'm not sure if there's a lot of that. I'm not sure that last one is that relevant at the moment, but inadequate collateral is probably the main one I would have thought for retail businesses. Again, it doesn't include businesses in the primary production of agriculture, horticulture, fisheries, so the primary agricultural producers don't apply. The refinancing of existing debts, again, this scheme is only applicable when people are looking for fresh loans, and property-related activities. So it's not for property-related loans. It's more for business-related loans. And just before I move on from SBCI, just to give a summary of what Nick Ashmore explained to us on his call earlier in the week. So the first thing he said was that they're seeing good take-up of the working capital loan, and they're seeing good take-up of the future growth loan in the last 3 or 4 weeks. At present, they haven't seen a huge amount of take-up on the credit guarantee scheme. They believe that that will come later. But for the moment, people are focused on the first two, the working capital loan and the future growth loan. They fully believe, and we're on the same pitch as them as well, that this crisis will have a number of phases. So we've had the shutdown and the hiatus. We're now looking at the reboot and the reopening. And that resumption of activity, the way they see it, will involve physical distances, reconfiguration of workplaces, for retailers, reconfiguration of the stores and so on. But then what you're faced with is the overhang of the deferred payments. So the taxes that were deferred, the rates, the rent, suppliers, even the moratorium on debt that you may have got for the banks. So all of those will need to be somehow dealt with. And they believe that some of these short-term funding measures that have been put in place will now need to be, termed out over a longer period. So while he had no specifics to announce at present, he said that there is a lot of conversations going on about, and they're looking at designing schemes that will take some of those overhang features that will have built up over this lockdown period. And the next waves of funding that you will see coming through from SBCI and other sources will deal with how these overhang positions can be termed out over a longer period. So he said they're in very detailed discussions. They'll have announcements over the next number of weeks. So while these are the current schemes that SBCI and Enterprise Ireland and others have, I think one can realistically expect further developments, further advancements. Some of these schemes been extended further or more money put into them. And I think the adaptation of some of these schemes to deal with the reboot and the reopening phase and everything that effectively comes out of that. So that's SBCI. Okay, so Microfinance Ireland, and again, so this is aimed at maybe the smaller businesses. Microfinance Ireland, the COVID-19 loan. The features of this loan are loans from 5,000 to 50,000, so it's designed for smaller businesses. Terms up to 3 years, so it's a 3-year term. No repayments or interest for the first 6 months, so you get a bit of a breathing room. Interest rate of 5.5% or 4.5% if you apply via your local enterprise office. So there is a 1% deduction for applying, so we would strongly recommend that you go in through your local Leo office. Fixed repayments with no payment for early repayment if people decide to repay early. The use cases, it's designed to support businesses who've been impacted negatively by COVID-19. So that would mean that most people on this call would apply for that. The criteria of a micro enterprise. So this is aimed at the smaller end of the retail market. A business with less than 10 full-time employees, annual turnover of less than 2 million, and net assets of less than 2 million. So it tends to be for the smaller end of the market. And it's for businesses not in a position to avail of finance from banks and other commercial lending providers, and where 15% of actual or projected either turnover or profit has been negatively impacted by COVID-19. And again, I presume that would be a test that most retailers could satisfy very quickly. The application process is via Microfinance Ireland website or the local enterprise office. And as I say, 1% cheaper on the interest rate if you go to the local enterprise office. The required documents include a COVID-19 business plan and cash flow forecast, 6 months bank statements, and credit reports. So again, that loan is available. That's out there at present until those funds are used up. So we would that may well be topped up in the future, but we've no visibility on that yet. We strongly recommend for the smaller retailers that you would go to your local enterprise office or the Microfinance Ireland website, look at the detail involved in that, and if that's the kind of level of funding you need and you satisfy the criteria, it's our advice would be to get busy and get an application in. So moving on from there, I just wanted to talk about some of the smaller, I guess, and other local enterprise office supports. So and really I wanted to just address two of these that are relevant to retailers. So the first one is the online trading voucher. So the local enterprise offices, there's 31 of them around the country. For enterprises with less than 10 employees and less than 2 million in sales, they have a 2,500 grant or voucher. Assuming that you pay 10% of the cost, they'll pay 90% up to 2,500 to assist the company in developing its online presence. So so this, I guess, for those companies who are smaller and perhaps weren't prepared to spend 12,500 on the Enterprise Ireland online minimum spend that they have for their support, then maybe for smaller businesses, the Leo online trading voucher could be looked at instead. It's a smaller amount, but it's 90% funding, so you get most of it back. The other one then is the Leo business continuity voucher. So this applies to businesses across all sectors employing up to 50 people. So this is up to 2,500 in third-party consultancy costs to develop short and long-term strategies to deal with COVID-19. And again, you apply through your local Leo office. There's a deadline of 15th of May on this one. So I would get, again, on the localenterprise.ie, which is the Leo website, I would encourage you to get on and look at the criteria and go in and do it. And it's available until the 15th of May or until funds are exhausted in the meantime. So I don't think one should wait around. I think if that's of interest, I would move quick. So that effectively summarizes the various supports that we see out there at present that are available to retailers. And now I'm going to hand you over to Dara Kelly, who's going to take you through some slides to deal with effective cash flow forecasting, and we'll have some Q&A at the end of that. Thanks.
Thanks, Jim. Good morning to everybody. My name is Dara Kelly. I'm a partner in the corporate finance team. I hope everyone's doing well this morning. I'm going to go through a piece on cash flow forecasting. As you can see from the majority of the supports that Jim is after running through, the preparation of a cash flow, both short-term and medium-term up to 3 years, is a critical component of the application process. So I'm going to run through some principles just for people to bear in mind, and we've got some tips and a couple of examples. So if we move on to the first slide, so when we're thinking about our cash flow, we've set out a number of questions on the left-hand side of the slide, and as we move across the slide, we talk about how do we gather the data and then our output. So thinking about cash flows, and you're going to hear me use the word scenarios and sensitivities quite a bit over the next 10 minutes. From the discussions we've been having with banks, the level of uncertainty is obviously huge. We hopefully will get some new information coming close to the 5th of May. But what does it mean for businesses? What does it mean for retail? Very, very difficult to plot that out. And then so scenario planning is going to be key. We can't just have one cash flow. We're going to have, probably 4 or 5 different cash flows, different start dates, different levels of business activity. So as we start to think about it, we need to think about our own, right? We need to think about retail. So what are the retail risks, right? So that covers probably for everyone. But each individual business needs to think about their own risks and then include those in the scenarios for how will we plan, how best we can plan to mitigate that risk. So the next, major point, we'll be sharing the slides on this, so I'm just going to pick, I think, the really important points. The next thing is cash generation. Do we understand our own organization's cash generation? How quickly we turn our stock into cash, a net of the suppliers we own? So we need to have a good handle on that, and that dovetails with working capital and how our working capital sets up. And that's moving from, inventory through to on the floor, whether we're wholesale, retail. I appreciate the majority of people here are retail. And how does our working capital, how do we tie up money in our business, and what's the way we can look at it to try and mitigate against that? And then on cash flows, two key things: what data are we going to use to come up with our cash flow? That's all historical data, but there's also wider economic data. But we need to have good information to use as a proxy when we start to roll out, and especially now with the level of uncertainty. And then we think about the key drivers. So this applies to any business. There's 7 key drivers when you're looking at a cash flow. We have revenue growth, we have gross margin / bottom line margin, we have our working capital, so we have debtors. I appreciate what might be a factor here, but we have suppliers and we have stock. And then we have capital expenditure. Well, we've overheads, and then we have capital expenditure. Now, everyone we're talking to is managing or just putting straight on hold the capital expenditure piece for the short term. So that takes one dynamic off the table, but the rest of it does. The rest of these 6 drivers is what makes up your P&L, but into your working capital, and that what comes out from all the activities, your cash. So how do we get this information? Well, we just get really into the detail of our own business and our own components of working capital, and look at opportunities to shorten the cash conversion cycle. Appreciate it's limited in retail because majority of it is done point of sale, but we still try to look at it on the flip side, look at it on the side of the supplier. Is there any ability to look at getting extended terms, different repayment process, consignment stock, that type of thing? So what we're trying to do is always improve our own cash flow, but also staying obviously within the lines that we need to stay into for continued business. The output then is your cash flow. With multiple scenarios and stress testing, right? But that's what we get from the process. That will allow us then look at where we have real gaps, look at the opportunities we might have to try and protect ourselves, but also when we then turn to lenders and say, okay, well, we've done the work, we've considered all the risks, we have various scenarios, and here is what we think we will need for under the following scenarios. Okay, because like, how is retail going to open up after 5th of March? Is it going to be later into the summer? What? So there's obviously multiple scenarios to start off straight away. Is opening, and what does opening look like? Am I going to only be able to ever have 20% of the capacity of customers in my store at the same time? That obviously straight away limits my sales. So it's thinking through all of that, so that it gives us good cash flows, that we can try and be as proactive as we can, that if a situation arises, we've thought about it, we know what it means for us, we know what it means for our cash flow, and therefore we know what the ask is when we're looking for funding support. So we go on to the next slide. We've just put a couple of tips. It's very, very practical stuff, but number one is, we all realize that profits, turnover and profits doesn't mean cash. It needs to flow through, and we need to think about the liabilities we're incurring at the same time as the cash that's coming in, and our overheads. So just having a really good understanding of the inflows and outflows, like pretty much the way your bank account operates, and I'll touch on a 13-week cash flow in a minute, which we have done on an in and out basis. Getting into that level of detail will develop and only improve your understanding of your own cash flow. And then when we get into scenarios, you'll really have a feel for how it might impact under the various conditions. Know your company's cash conversion cycle. Again, this can be very complicated for some businesses, but I know in retail it can become a bit more straightforward because you don't have significant debtors. Maybe if there's wholesalers on, you have that dynamic. But a lot of people that are on straight retail, don't have debtors. They have stock and they have suppliers, and they obviously have overheads. But just understanding again company's cash conversion cycle. Don't forget seasonality. And sounds very obvious. And how will seasonality play out for the rest of 2020? We don't know, but we'll do a couple of scenarios.
I think we may have lost Dara. It's Jim here again. So if you bear with us for a second, we'll just see. He may well have dropped. So we'll try and see, can we resume normal service?
Jim, I just might pick up Dara's piece.
Yeah, look,
just
David, that's perfect. So David might take over Dara's slot because just in case he's not able to get back in.
Hopefully Dara will chime in when he's ready. Good morning, folks. I'm just going to keep going straight into this. I'm conscious everybody is busy at this time, and hope everybody's well and safe. We were just discussing the multiple scenarios and crafting a few different cash flows, so you're not caught off guard if the client demands slows. Look, having a couple of models is going to help you out. What we've been trying to do is create sensitivities and link them to timings. And it's a little bit technical in terms of actually developing that out, but it'll give you the ability to run different scenarios and be able to adjust your cash flow on a weekly, monthly, quarterly, and annual basis. I suppose my own belief is that you won't be able to ramp up that quickly, and that you're going to have to take it in chunks. And I know if you're thinking from the SBCI perspective, or if you're doing the financial planning grant, which I know doesn't apply to a lot of the retailers, they're looking at 13-week cash flows and then a 3-year cash flow. And I think most continuity plans or most continuity financial forecasts should be structured in that format. So in terms of review, adjust and repeat, once you build it, it's all about having a look at it frequently, making sure it still stacks up, and making sure that you have the necessary liquidity to progress. So just moving on to the next slide now. Creating a cash flow forecast. So we're just going to run very briefly through these scenarios. A retailer orders products from a supplier, that's on day one. The supplier fulfills the order and delivers the products to the retailer. We're assuming 30 days supplier payment terms. Stock days we put in at 15 days, and it takes 30 days to be paid. That will be I suppose the typical scenario. The 15 days stock is held, retailer sells the products to their customers and receives cash, and then the supplier is paid 30 days after the product is delivered. So the cash conversion days in that scenario is 15 versus your payables. Second scenario is stretching it out a little bit, where we're looking at stock days at 40 days, payable days at 30, and the cash conversion days means an additional 10 versus your payables. So they're two simple scenarios where you can see you can see the difference from having a flexed cash flow and knowing that you're going to have cash 10 days later and planning around that. So we just move on to the next slide. So considerations, optimum cash management. This is a great slide just to leave up on your desk or to stick up on the wall, particularly if you're in accounts receivable or accounts payable, or the guys on your teams are, because it has all the components of working capital and the other cash management aspects that you need to consider. So I don't purport to go through each of these, but I think certain things that you need to consider is focusing on customers that are outside of credit terms and talking to them. The big thing circle that you put around the likes of this slide is communication. You need to be talking to all your stakeholders, and this is something that everybody is repeating, but it's to get past the exhaustion point. Keeping the personal relationships are going to be key to getting through this crisis. So if there is an option for cash on delivery, for example, maybe give a discount to try and get your cash in the door early. Management of your stock, I think nobody knows that better than retailers. I'm not sure I could teach anything there, but I think that the relevance is whether you can leverage some of that stock in either to obtain maybe a banking facility, and reducing your cash conversion cycle is the primary aim here. Other creditors, VAT and your P30s, deferring payments. I think most of your accountants, certainly your internal accountants, should be managing that process and availing of all the government supports in that regard. And to be fair to the banks and indeed the revenue, they've been quite proactive, and even the alternative funders have been the same, where they're willing to defer payments. So I suppose other creditors, cancelling non-essential standing orders, all these things that hopefully you've already done, because this is very much the stuff that would have been done in the first couple of weeks. But the key point, and it's just at the top of the slide, is monitor, project and stress test your cash flows. You need to continually look at all these aspects. So around the facilities piece, just to move on onto that aspect, whether you can look for increased limits or increased overdraft facilities, and in particular around being in a position to apply for the government supports that are out there. Some of them are short term, some of them are long term. The key point is when you are talking to your advisors, be it your strong relationship with a bank, or your strong relationship with your accountant, or people that you trust in business, make sure that you apply for the right one is what I would say. And then there's another aspect where probably needs to be thought about. The SBCI can cover the unsecured side of things, whereas you could get funding from SBCI, and you could also look to get funding from the bank, because there's certain restrictions within the SBCI funding. But you can effectively have two facilities, and opening up that opportunity will be important. So just moving on to the next slide there. This is just a typical simplistic 13-week cash flow example. I don't purport to go into it, but it's just the basics of what you would need to do. You start off with your receipts, you put in your payments, you see what your net inflow outflow is, what your closing cash position, how much availability you have in headroom in terms of your facilities, and where the pinch point is. And that's going to identify where your working capital requirement is. Just the next slide, please. The do's and don'ts, again, very, very useful page to stick onto the desk. A couple of things that I'd like to highlight in particular are, reconciling the long and the short-term cash flows. So you'd often see, budget, actual, and variance in most businesses. That's absolutely critical at this point in time, so you can identify where something is significantly below what was expected, and that's what we call maintaining a rolling forecast and updating the periods with the actuals, and making sure that your short-term forecasting is accurate. Management information is going to be one of the bigger critical factors as we move through this, and I suppose the key point that keeps on coming up is it's very, very important to create that conversation with your stakeholders. And if you're having some movement, a negative movement that is flagged early, and you can come up with a short or medium term plan to try and deal with that. Some of the actions to avoid, or the don'ts, is the blind faith and optimism and relying on modeling one scenario. Look, I think we've spelt that out in some detail already. I'm just, one of the other aspects I think is really, I'd encourage you to get someone who understands your business, and then someone who understands the funding side of it or the banking side of it, to look at any scenarios that you're putting forward and seeing whether they're realistic against what the economic forecasts are, specific to the economy overall or specific to a certain sector. So in your own time, you can read through these actions. So moving on to the next slide. I think we're going to move this into Q&A, so I'm going to hand it back to Jim. Thanks.
Very good, David. Thank you for stepping in there, and I see Dara's back on as well. So Dara's available for Q&A. So there's a Q&A button at the bottom of your screens. If anyone has any questions, please feel free to throw them up while you have the three of us available, and we'd be happy to deal with any questions. We have one question so far, and I'll take this one because it's an easy one. I said I keep the hard ones for the two guys. So Michael C, excellent update. Will you be sharing the slides? And the answer is yes, we will. We will be sharing the slides and this presentation afterwards, and we will distribute that to the people who have registered for the call, and we will also distribute it through Retail Excellence Ireland through David Fitzsimon's regular updates, and so we'll do it that way. Again, if there's any questions, feel free to type them in at this stage. And maybe I'll just begin to start summing up, because I'm not sure we're going to get a lot of questions. But what I would say, sorry, I just see under chat now we have a question coming up. Can you apply under more than one scheme? If you fail under one, apply under another. So the reality is, yes, you can. There's nothing that would prevent you applying under different schemes. And if one doesn't work, you can certainly look at another, certainly with SBCI. But I guess what I would say in relation to that is if there was a specific reason that was made clear to you why you didn't qualify for one scheme, just make sure that that reason doesn't automatically exclude you from other loan schemes that they might operate, for example. But in general, just because you mightn't technically qualify for one doesn't mean that you shouldn't consider applying for others.
Yeah, and to add to that, Jim, I suppose, like, if anybody has already applied, or they may be familiar if they've gone onto the SBCI website, you have to nominate an innovation criteria, as Jim had already mentioned. This was a follow-on from the Brexit loan scheme. So under the European Commission rules or state aid rules, you had to create an innovation activity, and I think that's probably put off certain people from applying. I think this is pretty relevant. There's about 11 criterias. If you've been active in innovation, that covers off about 6 of them. If you're considering an innovation business, that's about 2 of them. Or if you're seeking to enter new markets, which I think might apply very well from the online perspective for the Retail Excellence Ireland members, that's criteria 2, and that's probably the better one to select. But the one thing I would say is, I think that there's only been something like 1% of all applications denied on the innovation criteria, and basically we're trying to fit a square peg in a round hole in terms of using the Brexit scheme. So there's going to be an element of flexibility around that. So I think it's important to apply and not look at the SBCI criteria, innovation criteria, and think that you're not going to be able to qualify, because even if you ring up the SBCI, they're very helpful in that regard. Just something to mention.
Very good. So there's a further extension to that question just now that the full question has come in. So it's basically, can you apply under more than one scheme? If you fail under one, can you apply under another? Should you wait to apply under the GSC scheme now, or wait if terms of the schemes will improve? And how negotiable are the terms and rates of the various loans? And finally, can you apply, get approval, and only draw down if and when you need funds? So maybe, David, I might just hand those ones back to you, from an SBCI perspective in particular.
You're eligible for about 6 months, so you can get approval for 6 months. The one thing I would say is, if you're not going to use it, please tell the SBCI, because it'll fill up the usability of the scheme, or if people are saying that they're going to use it, and it stays there for 6 months. In terms of waiting for the scheme to approve, I wouldn't be overly worried about that, because it's the eligibility criteria that you want to get there. Like, my view of the world and what we've done with a few of our clients is we're talking to the pillar banks, or we're talking to KBC when it comes to the future growth scheme, in advance of even putting in the application. And what I'd mentioned briefly already, you could, the way one of the disallowable criteria is around, you can't use this to refinance loans. by all means, you can go to a funder and look for let's call it a secured loan to refinance your facility, and also get the unsecured piece via the SBCI. So I think talking to your banks or talking to qualified advisors who will advise on that is the way to go. In terms of the rates and how negotiable they are, it's actually set by the bank. But what the SBCI does is put a ceiling on the interest rates. So, you know, for instance, I think it's 4% for the credit guarantee scheme, or sorry, not credit guarantee scheme, for the future growth scheme. But you might be able to get it at 3.25 or 3.5, and a lot of that will depend on your relationship with the funders. One of the big lacunas, we'll call it, or gaps in the whole thing at the moment is what's happening with the non-bank lenders. Like, I don't have an accurate percentage on it, but there's probably 15-20% of the entire market that aren't funded via the pillar banks, and whether they will get into the queue, and then they'll have to look at certain other aspects. So I think anybody in a bank is going to look after their own clients first. They are open for new business, but you're going to have to utilize existing relationships where possible. So if you had an ID line on your senior charge, or your first lien was with an alternative funder, I think it's important to try and leverage those relationships to try and talk to the banks. I think the last question, can you deal with your local banker as a process centrally? You'll deal with your relationship manager, and it's being most of them are being processed within the business centers or the business bankings within the different banks. So once you get your eligibility voucher code, that's what you bring to the funders.
Yeah, I just might add one piece to that, just in terms of the banks. So the what we picked up anecdotally in talking to SBCI and talking to the banks, some people have asked the question, are they only dealing with their existing customers at present? The reality is that when the floodgates opened, it was their existing customers that would first and foremost would have gone to their bank to look for some kind of forbearance. And typically what they've looked for is a 3-month moratorium, which in all cases, in the majority of cases, we understand has been given and granted usually within 24, 48 hours. That 3-month forbearance, each of the banks have indicated that they understand it's likely to be extended for a further 3 months. So you might end up with 6 months forbearance or moratorium, and the options are a capital moratorium or a capital and interest moratorium on your debt repayments. And that's an easy give for them, and they make a quick decision. They've been heavily influenced by the Department of Finance and others, the banks have in general, that they need to be seen to be turning off the tap on those repayments for that period of time. So there's 3 months is there for anyone to get, and it will probably be extended by a further 3 months. The banks are open for business, but typically the flow that has come at them so far has really been the existing customers. But they are open for business. They will look at new business as well, and they have been dealing. The other I think initial thing they've had is our overdraft extension applications or overdraft applications, and again they've been processing a reasonable amount of that as well. So that's just an answer on that. So there's a couple of other questions here. John Appleby, can you get the online EI grant if you've received one before? I'm not sure about that. That's probably one we'd have to check. I do know for some of the innovation vouchers or some of the vouchers from Leo, it specifically referenced that if you have received the voucher before, you can receive it again. The online voucher from EI, I would need to check that, and John, we can get back to you directly on that. I would have thought if you've applied for it before, but you haven't used up the maximum availability, that maybe you could go back in. I doubt if you'd be able to apply and exceed the maximum terms, if you know what I mean. So the 50,000 maximum spend, if you'd used up 10 or 20 of that before, I'm sure you could apply and use up the remainder, if you like, if you were successful. But I doubt if you could get any more than the overall max, because I think under the EU grant rules that Enterprise Ireland would be governed by, there would probably be a lifetime or an overall limit on a company getting an amount. So, but happy to come back directly on that. And then
I think it's 200,000 of de minimis aid per business undertaking. Yeah. So you should be covered unless you got a huge grant previously, to be honest.
Very good. And then Another question here then is from Billy. I'm being charged 7.5% for my bank on extended overdraft. Is this right? Again, I might hand that to David.
It may be right, but it's not necessarily fair, Billy. I think is the best way to describe that. I think in reality, I think you need to talk to the bank. That sounds more like a personal overdraft rate than it would be, and I don't know what bank you're talking to, but that would be significantly higher than what we would see for SMEs. Like the old traditional system used to be the lower loan rate and then the higher AA overdraft rate, kind of in around the, I think it was stuck on 8.6 for about 20 years. But you should be able to negotiate that down is the best thing to say. I would definitely be talking to your bank in the current environment around that. They just need to change the overdraft rating. If you've raised it before and they're not doing anything, that would be unusual, would be my view of the world.
Okay, that seems to be all the questions that are here, and we're bang on the hour. It's 11:30, so I just might summarize very quickly, and then we'll finish up the webinar. We are about to move into the next phase, the reboot and the reopening, as we've called it, and I'm sure as retailers you're all focused on that. There's a couple of critical things that we think, you know, as people in business and specifically retailers, you need to do. You need to plan. So you have to constantly plan for the landscape is changing the whole time. So you have to be constantly planning for that. Number two, build a cash flow model. So even if you might think you're keeping an eye on the money coming into the bank, or you're getting your accountant is giving you a profit and loss account every month, cash flow is what it's all about for the remainder of the year. So build a cash flow model, understand it. The 13-week, the significance of 13 weeks, 13 weeks is 1 quarter. So people can do annual cash flows, monthly cash flows, but if you're going to do a weekly cash flow, then you run it weekly over 3 months. So hence a 13-week model. And the key thing when you have that model built is that you update it. So you update it each week for the actuals, and you roll it forward with a new opening balance. And then you sensitize it. So you run different scenarios. You do the scenario planning. What happens if my cash flows drop by a further 20%? What happens if I had a delay in getting paid for this, or if I was able to defer some of my payments? So you're constantly sensitizing it and looking at the scenarios. And then if some of those scenarios become reality, if you've been through them already, you're much better positioned to actually react to them and deal with them. I think the third thing is consider the overhang in your business. So most people have stabilized their businesses. They have they've spoken to the landlord. They might have stopped paying rent or slowed down paying rent. They possibly deferred their VAT and PAYE, possibly even their corporation tax. They have, they've availed of the wage subsidy scheme. They've maybe put the moratorium on capital repayments. They've probably dealt with the local authority in terms of rates and stuff, and probably dealt with certain suppliers. But that creates an overhang. So be aware of that overhang. Be aware of when the pressure points are coming back again. And we think it's really critical to engage early with stakeholders. So whether it's banks, landlords, whatever, engage early, be upfront, be on the front foot, go to them. Don't necessarily wait for them to come to you, because it may be, the situation may be too advanced at that point in time. And there's no substitute for being upfront and going to people and explaining the concept of the affordability that you may face within your business at present. At Grant Thornton, we would be delighted to assist you with any of those, any of the funding applications, any more details on any of this. We will circulate this webinar and these slides to you guys directly, but also to the Retail Excellence members. Our contact details are at the back for the people on the call and the other people on the corporate finance team. Don't hesitate in reaching out to any of us. Thanks very much for taking the time to come on the call today. We really appreciate that. And as the funding mechanisms change and develop and advance, we will certainly consider coming back over the coming weeks and months to provide an update webinar in terms of what the funding landscape looks like. So thank you for your time today, and stay safe, and best of luck in the reboot and reopening of your businesses. Thank you.